it's going. Hi, my name is Alexander. I'm a managing director of Entitlement Capital. We're an investment advisory boutique, and we specialize in advising our clients, especially in capital composition and in any transaction-related services, specifically more concentrated on debt. But we also engage ourselves in the startup community. We place some bets, some small bets, like business angels, and like to see how the startups grow. But we also help startups in terms of formulating investment theses for investors. I think any idea needs to be represented well, needs to be prepared, and you need to make it as attractive as possible to investor and help him to make an easy decision to invest in it. So those are two fields that we specialize in, and one special feature that we always preach about is the topic that I'm going to talk to you about today. And it's not a very nice topic, but I think we should talk about it. And the topic is our financial system. And in our view, the financial system is a total crap, and it's about to crash. So if we look around ourselves and say, guys, this is a great time because stock markets are at the peak levels. We are having economies booming, growing solidly according to our governments. Cheap credit drives consumption. We have technology company blossoming, and venture capital just invested as much money as in 2000, about 60 billion. But two things that we don't talk about is that basically this whole world is financed through debt. We're printing money like crazy, and this all leads to extreme asset price inflation. This is basically the main idea how it works. So if you're, I would say, a normal citizen and you are working for a company earning a decent salary, try to buy a flat somewhere in the middle of Berlin. I think we all know that it's almost impossible, and it's mostly driven by this hot capital that's flowing around the world, basically. This government liquidity disturbs the markets. So there are no markets, there is no diversification, there's nothing out there that would help me as an investor to make a judgment call. And just to give you a relation that how crazy the times are, it's when we compare to 2000, and last year there were three-fourths of all IPOs were not profitable. It's basically the same picture we're doing again that we've been through 20 years ago. What does it mean? Basically, after the financial crisis in 08, 09, all big central banks went on a money printing streak. Basically, Fed, ECB, and Bank of Japan, they printed $10 trillion. Sounds like a big number. Just to give you a perspective what a trillion is, if we would say what is a 1 trillion seconds, 1 trillion seconds is 33,000 years. So basically, if we go 33,000 years ago, I think we are way before the Stone Age began. So just to give you a perspective how much money is out there. And the problem is not the money, is not the credit, because credit can be very productive. The problem is that you see here, it's an example of the US, is that there is too much money chasing too little asset, real asset, because the red line is the GDP growth. It's basically what an economy produces, or basically the real assets out there. And the blue line is the credit expansion. This is the debt that is out there. And now, basically, to generate $1 of economic growth, we need to print $4 of, just out of the thin air, of credit. And it's highly, highly unproductive at this moment. And to give you the perspective where we actually should be, is that this blue line up there should be more closer to the red line in order to have it, like a normal world where the prices would reflect the actual value of the assets out there. And the way we need to go down is the red, just to give you another perspective, is this red bubble there. It's the great financial crisis. This was the most expensive crisis ever. We burned over $40 trillion. They just disappeared out of nowhere. And what we did, we basically said we have a debt problem, and we just poured more debt onto it. And it tripled out, and we did it globally. So we're now facing this problem on a global basis. Basically, on a worldwide perspective, if you look, whether it's households, finance corporations, corporate sector, everyone is borrowing recklessly. Our worldwide GDP is around $80 trillion. We now have around $240 trillion of debt, which might sound not that much, given that it's just 3 times leverage. But if we would assume that this pile of debt would have an interest rate of 2%, this is not much. The usual natural interest rate should be around like 4 to 6, let's say 5. The interest expense of this basically debt would be 4.7 trillion. And the problem with this is that last year our GDP grew only by 4 trillion. So we are basically not earning enough money to pay our interest expense, not talking about even the principal. So we're borrowing to pay our debt, which is obviously not really sustainable. And this is basically where we're at. We live in a huge casino where capital dictates what's happening. For how long is a different question. But this whole system is basically based on one paradigm. We are bringing the future consumption to today. If you borrow today $1, you'll have to pay it back tomorrow. If you spend the dollar today, you will not be able to spend it tomorrow. And what the governments did, they say, we start money printing and we drive down interest rates to 0. And the interest rate is the major factor that drives an investment decision. Basically, if you have an interest rate very low, a lot of projects that otherwise would not be financed, that are not profitable, get financed. And through this, we create an extreme oversupply of capital, an extreme malinvestments throughout the economy, and we have a supply overcapacity of an extreme conditions. So basically, usually, what would happen is the interest rate will go up, and all those unprofitable projects would need to be punished, they will go bankrupt and will disappear. What we decided, of course we're so clever, we decided to skip this place, that step. And we decided, no, we're going to keep the interest rate low and we're going to continue. The problem with this is that we as people, when we are actually in a good condition, we tend to gamble. We try to get more, and more. And this leads to, this is the company in the US, Bianco Research, they basically looked at the 1,100 S&P companies out there, and they found out that 15% of these companies are not earning enough profit to pay their interest. So this is exactly the situation where companies need to borrow in order to pay their debt. And 2 biggest examples how this will go wrong are Tesla and Netflix. Both companies, I mean, Tesla is worth more than Ford, as much as GM. They produce 100,000 cars, which probably Ford produces in a week. And they burn at least $2 to $4 billion a year. They're not going to be profitable anytime soon. They probably will need around 10 more billion of capital just to stay afloat. And they're not really getting their production with Tesla free. It's a huge, huge mess. So I think this will be the company that will fail first. Netflix is very similar company that based on burning cash. We live in a paradigm where top line growth, customer growth is everything. We don't think about profitability of the business. It's not important. But it will strike us back, and just for a simple reason. Because both companies, they rely on this cheap supply of money. They need either to borrow the money or to place equity to get the operation financed. And as long as the stocks are so highly valued, it all goes well. Because debt providers and equity providers, they keep relying on each other. They say, If I'm a debt provider, I say, whoa, the company is so much worth, I can give another billion, just credit, no problem. We have so much value in the company. And the same thing, what the equity investors think, they say, whoa, my God, we can subscribe, the value is great. They always can raise some debt to pay some of their expenses. And the problem is that when we start raising interest rates, and this is happening already in the US, the company will come extreme under stress because they need to borrow more, they need to pay more interest. The cash flows that are already negative, they will be stressed even more. And when this whole game blows up, you go into spiral, and basically those companies will not be able to function. It's just as simple math as it is. If we move on and say, guys, how are the valuations? Tech is great. We're visionaries. There's a lot of great companies like Uber, like Dropbox, Salesforce. And if we look at the valuations, the ratios that you see here is the price-earnings ratio. This is basically the major ratio that explains you what's the value of the company. And basically, if I take an example for Amazon, right? What it says that if I invest $1 in Amazon today, it will take the company operating in the current condition, in the current form as it is, 183 years to earn that dollar back. I'm not sure if anyone wants to gamble that Amazon is around the corner in 183 years. But this whole philosophy is based on, I'll get in, and before it crashes, I'll get out. So you're always hoping to find someone else who will pay a higher price for what I pay. And this is clearly not sustainable. I'm a finance guy, and I was told that, discounting cash flows is all great, but a normal mean ratio for a sound valuation of companies is around 14. You see that Apple is valued around 19, which is not that much. But Apple is not a growth company. Apple is not a startup. It's really already a matured business. It's a cash cow. If they grow 4% a year, that's their basically maximum what they can get. And that's why they're valued not that crazy. But even if we take all the technology stocks, which are really, really out there and really attract a lot of funds at the moment, we see that this one was the 2000 crisis. And this is Dow Jones Industrial Average, which does not include any tech stocks. And this is where we are now. So if that's the bubble, please explain it what is up there. And I'm really saying that we are about to have a biggest crash as ever was there. It's going to be monumental because we created through this liquidity situation which is so fundamentally wrong and cannot function that it needs to crash in order to regain the ability to work again. And this is an interesting chart because if we compare the performance of S&P for the last 4 years, this is the black line, it goes here just a bit below, to the 4 years prior to the 1937 correction of S&P. The stocks, the blue line that goes down there, went over 50% down. And if we compare this development over the last 4 years, the correlation between those two events is 94%. So I mean, if history teaches us something, maybe something big is coming. But as I said, you can run, you can hide, so what's going to happen? I always say the world is not going to end. We're not going to die. We will live through 2 world wars. Somehow we're going to go through this period. But we need to prepare ourselves. We need to be aware of the fact that we're going to go through very tough times. And I think the first implication is that the capital will dry out. And it will dry out like this. Because the way the money is created nowadays, it's not like someone goes and prints it in somewhere in the basement. No. If you go to a bank and I get a loan of $1 million, the bank puts a record. It's just they type in 1 million, 7 figures, and 1 million is created. That's it. There's nothing else behind it. So it's just a pure, out of thin, created money. And it disappears exactly the same way. And once this capital starts to disappear, there's just going to be a huge liquidity problem. And all the markets that we have created, they're just liquidity addicted. It's not about the valuation, it's not about how much we're earning, it's just the liquidity. When people get scared and when the herd starts to run, then we have a big problem. We had it in '08, and instead of letting this whole crap collapse and start from scratch, we decided to elevate this whole thing. The second thing is just for you out there, you who dependent or who thinks that VC is going to be a suitable channel for raising money. I make a fat call. It might not happen tomorrow, but I think VCs will have a major problem with their business model because they basically have commitments, but they don't have cash. And when they want to make an investment, they make a capital call. So they need their clients to pay the money in. And when the shit hits the fan, I think most of the clients, like pension funds, like other big institutional investors, will have problems. We have a very illiquid asset, and people will say, I'd rather lose 5% of my money but stay in the liquid market than gambling on some future that I don't know how it's going to turn out. We had this in 2000, 2001. It was a major problem, but at that time it was not as systemic as it is now. I think for me, all the top scaling businesses, everything that has to do with consumer goods, those models will fail first. Your inability to earn profits will chase you because we'll be having a financial situation where cash will be the king. And if you're not earning money, you will be punished for that, and the companies with the cash will buy you for a fraction of value you are valued at now. And I think the problem with the consumer goods is that we actually the private sector is so deeply indebted that at a certain amount of time we will need to think about, do I need to buy a new iPhone every 2 years, or can I walk with it for 4? So the top lines of the gadgets and all the stuff that you don't need every day will definitely have a major impact in the short run. But I mean, being aware and understanding the implications of what's going to happen, we don't know what's actually going to happen and how the governments, how the market's going to react. So this is basically, as one finance guy said, there are two types of predictors out there: the ones that don't know and the ones that don't know that they don't know. And basically what we can do is concentrate on the things that matter. I think understanding where your business model is vulnerable is very crucial. You need to go out there and understand, what are your suppliers doing, what are your customers doing, what are the possible implications on your business model, because once your customers are unable to pay you, you face problems because you need to pay salaries, you need to business development, and so on and so on. So you need to be prepared for that. And in order to be prepared, profitability is crucial. Having cash is always helpful, because having cash gives you the possibility to cherry pick when the things go down. It's going to be really cheap because we always overreact. It's not going to be, oh great, we're now going to go exactly to the mean average. No, we're going to go right to the bottom, and then we're going to go a bit up. And so if you have cash, if you have resources to deploy, this is going to be a major advantage. We can talk about whether you can have a gold or crypto coins to diversify your exposure to fiat money, which we also don't know what's going to happen to, because this is the biggest crap on earth is our fiat currencies. And I think if you go that route, and if you're planning to raise capital in the near future, my single advice, forget the valuations, raise as much money as you can. Just make your pocket. Usually you won't hear that from investors. I never would do that myself, but actually, if you're raising money, do that, because when times get tough, you don't want to be out there raising capital. And people who've been there in 2000, 2001, when it was really tough, they will tell you it's not fun. And it struggles you psychologically, it drains you down, and it really affects your personal life. So, is Bitcoin something that's going to save us? Well, to be honest, I don't know. And the system itself is so immature. We hardly have commercially viable applications for a lot of distributed ledger technology. We don't know how the governments will react. So yes, when we say the technology is not dependent, you cannot hack it. Yes, technology, yes, but we still live in a physical world. So if I'm in China and I have a mother who is sick at home, I will not be able maybe to move that easily if I'm like 20 and I don't care where I'm at. And at the end of the day, this whole libertarian thing is very great, but this technology can also maybe result, if a large population adapts some private blockchain, we might giving a key to governments to even more control. That's what's basically happening in China with face recognition, all this stuff. My message here, the world is not going to end. I think we all muddle through, but I think we need to be a bit aware of this issue and stay attuned and just enjoy our life. And basically, this is very good. It's really not over until the fat lady sings. Just the last thing. I'm kind of like preaching this whole stuff around, and then I recently started my YouTube channel where I talk about this all kind of misallocation of capital, all the crazy stuff that's happening out there. The channel is in Russian, so please free to tune in and comment, like, share, whatever. I would be happy to have you as a viewer. So from my side for today, it's it. So I'm happy to answer your questions, maybe afterwards or maybe now. Let's go.
We have 10 minutes. First of all, thank you.